As the song says, don't stop believing, even in this particular market that we're in at the moment. I'll tell you, I was talking to our first speaker during lunch, for a good portion of the lunch, and he had me so inspired that if I'd been in year 12 at school, I would be choosing my career to be a geologist, Steve, because he just had me by the proverbials with his enthusiasm and his passion for what he's doing. So, geologist by trade, he's currently the Chief Technical Advisor for Belararox. Now that's an interesting story for one, but one of the things that he said to me was, if you're going to look for elephants, just go into elephant country and look there. I thought, well, that sounds very, very logical. So that's what they're doing. They're looking for copper. They're in the middle of this beautiful copper-rich country, and I'm going to let him take you on the journey because he's absolutely mesmerising. Would you please welcome Dr. Steve Garwin.
Thank you very much, Chrissy. Yes, if you want to find elephants, you go to elephant country, and in this case, we're looking just for the little snorkel of the elephant that people might have missed before. This is a picture of one of the locations that was taken in October. We began fieldwork in October, and this is in the Andean porphyry belt of the Argentine side of the Andes. I'll let you read that at your leisure. Further comments about competent persons. All this has been released previously on the ASX. Belararox
I nearly got some lunch. I was very excited.
I didn't get that. Okay. We're talking today about the Tambo Toro Malambo project in San Juan, Argentina. This is a package that, of ground that's been put together over about the last 16 years and brought by Jason Ward to Belararox. It's about 32,000 hectares. It's in between some very large deposits. This would be a Veladero 11 million ounce high sulfidation gold system to the south, and Filo do Sol and another porphyry system, Jose Maria, to the north. Belara also has the Belararox project, a zinc project in New South Wales, and the Bulletin lithium project in WA. However, the focus of this talk is the copper, gold, silver potential of San Juan, Argentina. So the top two fellows, Neil and Arvind, they're the founders. John Tracos is also a director, and Jason Ward is the fellow that brought the prospects to the party, if you will. He's the one who's been in Argentina for many years and picked up some very interesting ground. And then you can see the management, of which I'm included as the chief technical advisor. I do this for a few groups. And then Janina, who is the project manager in Argentina. The key note here is that there's only 71 million shares outstanding, and majority of that are held by management and top 20 shareholders, so it's a tight structure. So again, as I mentioned, we have large deposits. Veladero, 11 million ounces, mostly produced now. Pascua Lama, Filo del Sol, Jose Maria, and in this gap in between, it's about a 100-kilometer gap in between, there are some known prospects, but no mines. The area has been systematically underexplored, in my opinion, for a number of years. Hence the comment about looking for elephants in elephant country. Now, what we did initially here is look from space. Some of these alteration systems are so large, you can see them with Google Earth. All right, and we didn't pick the targets because of that. We went and had someone process it, and you can see these interesting sort of lines on this map. This is basically using satellites, hyperspectral work, to look where the clay and sulfides, such as pyrite and chalcopyrite, might be. You can see the existing deposits and prospects in red for copper, in yellow for gold. They have a pretty good relationship to the satellite-deduced algorithms and interpretations. So that gave us a very quick jump on where to go in the field when we started working in October. There's very little forest. There's no trees. There's no soil. So literally, you can see the footprints from space. The task is to go there, do mapping, do sampling, do some geophysics, and establish the flames that make the smoke. So we want the economic metal concentrations amongst these large, more than square kilometer sized hydrothermal systems. So from the satellite imagery, and we released this in May, we designated about a dozen targets. Excuse me. The better ones here, or at least they look better from the size of their alteration footprints from space, are in red and in purple. We've gone ahead and mapped and sampled these three, mapped and sampled this one, and now are just accessing this area, and we'll continue that mapping and sampling and geophysics in the next coming months. Now, just to, size matters, okay? In that, here's an example of one of our best targets here, and you can see the scale bar, so that's about 4 kilometers of strike length and 2 by 1.5 kilometers for this southern hub of alteration. And this is Filo del Sol, which has got some drill holes that would run 1,300 meters at 1.3% copper equivalent. This is a serious ore body right on the top of the Andes, on the Chilean-Argentine border. In fact, the resource goes right across the border. And so what we're doing here is just showing, look, some of the satellite interpretations and aster imagery, there's the size, the same scale of this large mineral resource at Filo del Sol, 4 billion pounds of copper, 7 million ounces of gold, 165 million ounces of silver, and they're just getting started. And here's the size of this anomaly. Now, that's just an anomaly. Our job is to go there, map it, and see if we can find a metal concentration that will allow us to drill. Now, this is what it looks like in the field. You can see this is one of our areas here. That's about 4 kilometers by a kilometer. It's now been sampled and mapped, the entire area, since this diagram was made. This is some of the satellite imagery anomalies. This is what the field looks like, okay? So the guys are out there doing the hard work, doing the mapping, and this is some of the same team that found 3 deposits for Sol gold in Ecuador in the past decade, including the giant Alpala deposit, which you may have heard about at the Catskill project, of which Jason was involved in and I was involved in. We've brought some of the same Ecuadorian geologists across, and they're doing the work here. So we know what the systems look like. If it's there to be found, we will find it. And there's some of the geology maps they're making. And already you can see in this area, there's a 500 by 400 meter target there that looks very compelling based upon the geology. We're still waiting for our geochemistry to come back. Although we know what to look for in terms of the abundance of veins, secondary copper, sulfide abundance, fractures and rocks that say we might be close to a porphyry center. This is another target to the south. This is, again, you can see the scale here. Oops, excuse me, don't want to jump to that just yet. Okay, so that's about 1,200 meters by 800 meters, strongly altered system, telling us we want to go towards the west from the mapping. Lots of fractures, secondary copper occurrences, certain ratios of goethite to jarosite, that all is basically telling you go towards or go west, young man. And you know, some of this stuff does look pretty good. You don't have to wait for assay to see that there's some copper there, not only in the atacamite, the green mineral, but in the black neodicite, the manganese iron oxide. So here's what we've done, and here's what we're doing. We didn't get in till until October, and that's when we started doing field work. The whole package was only picked up in May. So now what we're doing is basically more mapping, surface sampling of rocks and colluvium, and we will be doing ground-based magnetics. We'll progress that through until the snow starts flying, perhaps in June, and we'll have about a 3-month period where access is difficult. By then, we will be able to integrate the geology, the mapping by the guys that found a Paula deposit for Sol Gold. We will then have the geophysics results, magnetics, we'll process that as we have in the past. We will have the geochemistry and work on 3-dimensional models of the zoning, not just the geology, the geophysics, but the chemical zoning that tell us how proximal we might be to a porphyry center. All right, and this is looking like the upper to middle levels of porphyry center from mapping. The geochemistry will assist with that. So then we'll come back in September or early October and drill our best targets. Very simple plan. And if something's there to be found, we will find it. And lastly, that is our camp. It's at 3,000 meters above sea level, which you can drive to directly off the Barrick Mine Road to Veladero. Thank you for your time. We have a booth here, and you're welcome to visit us. Thank you.
He's good, isn't he, Avram? We like him. Love to have him on our team. Thank you so much, Steve. Right, I just had a look at the weather Bureau's little feed. It's gone down to 34.4 degrees. We've dropped 6 degrees in just over 45 minutes. There you go. There you go, Luke. They've all come racing in here to listen to you, so don't worry about that. This is Luke Meter. He is the newly minted CEO for Accelerate Resources, and he's pretty happy with his choice of job. He's pretty happy with what they're doing out there at the moment. Drill-ready lithium targets in the West Pilbara. We're heading out towards, you're Roban or more towards Karratha, aren't you, at the moment?
Closer to Karratha.
Close to Karratha, so a really nice location with lots of really good infrastructure and backup there. Would you please make him very welcome in his first job in his new role as CEO?
Thank you very much, Chrissy. As Chrissy said, I'm here to talk to you today about our very exciting drill-ready lithium targets and manganese, all part of the critical metals greening space. Before we get going, the normal disclaimer and complement person statements, you can find all that information online on our website if you want to read that a bit further. Okay, so a bit of a corporate snapshot on Accelerate and who we are. We have 3 main projects across Western Australia. The first one is our most recent purchase, which is the Karratha Lithium Project. We also have the Woody North Manganese Project, which we recently just released some resources on. And we have the Comet Gold Project. There's 610 million shares on issue, 220 million performance rights and shares. As of Monday, it might even be today as well with the announcement we had, we've got a share price of around 3 cents, which gives us a market cap of 18.3 million, and just shy of 2.9 in the bank, and that's from the quarterly in 2020, December quarterly. The team, as I just mentioned, I'm the newest member of the team. I'm a geologist by background. Predominantly spent the last 10 years working in and around the Pilbara, so I love this part of the world and know it quite intimately. Before coming to Accelerate, I've been an exploration manager for Artemis Resources, Novo Resources, as well as senior geologist for the TEM project. Along with that, we've got great technical experience of Richard Hill and Dr. Steve Bodden, both geologists with excellent credentials. And on the corporate side, we have Yaxi and Grant, who certainly helped Yaxi and me along the way with the work we're doing. We also have Kevin Joyce. Kevin is our lithium exploration manager, and he's definitely got the pedigree for finding giant systems. If we're looking for elephant country, he's the person to have to do the hunting. Kevin's got, more recently, he's been exploration manager for Regis Resources, and was also the person who put together the Leah, what is now Leah Lithium's Carbonetha project, which is over 200 million tonnes at around 1.4% lithium. So he's got the pedigree to be able to help our project move forward. So why invest in Accelerate? Well, we've got 90 square kilometres in what could roughly be said to be the most exciting lithium project built in Australia at the moment. We're only 35 kilometres away from Azure's new discovery in the Andover province, and of that, we said we've got 90 kilometres of ground. We've now got the Princeps Lithium project. It's a new discovery. It's walk-up ready drill targets, and we'll go into that in a lot more detail shortly. And in that project, we've got rock chips over 2% lithium coming through. We've also got an extensive pipeline of exploration targets within the Karratha project area. And then we've also got our manganese exposure. We've got the Woody Woody North project. We've got some new resources that have just come out, and we'll talk about that as well. We've also got gold exposure around Kew, just south of the Tuckabianna gold mine. However, for this talk, we won't be concentrating on that. So the big question is, why lithium, why manganese? Well, they're all part of the new greening of green metal revolution that's happening across the world at the moment. And for lithium, there's been a lot of people been speaking about this, but the production for lithium is increasing dramatically. In 2022, is approximately 243,000 tonnes of lithium being used, and now it's projected to rise to 2.4 million by 2030, which is a 7-fold increase. Additional to this, we have the manganese projects. Manganese itself is one of the most widely common metals in the world. I think it's 4th or 5th most common used metal in the world. And the big jump of technology that's happening there is the manganese input into the battery world. So currently it's around 4% of each battery is made out of manganese, and it's expected over the next 10 years that the amount of manganese being put in the batteries and the production rate for it is going to increase 8-fold. So the Karratha Lithium project is a recent acquisition. It was only put together in October last year, and we just signed off the paperwork in the last few weeks. It really is a transformational acquisition for the company. As we mentioned, we've got walk-up drill targets, we've got the brand new Princeps discovery, and it's got scale potential. We've got 90 square kilometres in the hottest lithium ground in the country, and we're right next to a tier 1 mining jurisdiction. You can't get much better. Princeps itself is only 15 kilometres from Karratha and 20 kilometres from the port of Dampier. So Princeps, it's a new high-grade discovery. It consists of two trends, the southern trend and northern trend. The northern trend is what's really got me interested, and this is why I had to come over to Accelerate. This is spectacular. It's to date over 1.8 kilometres long. We've defined mineralisation over 1.5 kilometres of that. In the central region, just through here, with the mapping there, that there is at width, at surface outcropping. It's 45, 60 metres over 1.2 kilometres. Besides a little bit of area where it goes undercover. Additionally with that, we also have the southern zone, which continues onto the KOB extension, which other companies have spoken about more recently. That zone's really interesting. It's all these sheared dikes of pegmatite with spodumene in it, and we have widths there of up to about 50 metres. Today we released a new announcement, and it's looking at the continuity of the mineralisation that we're seeing in the northern pegmatite. So I had fortunate enough to have my first trip a few weeks ago, and the first thing we saw was how much mineralisation was there. So we said to the team, let's get out there, let's do some north-south traverses across the main area of outcrop, which is about 650 metres. Every 5 metres we did another rock sample along these traverses just to see the distribution of mineralisation. And what we did find is that pretty well the whole thing is mineralised, up to 1.6%, and with the majority of samples over 0.5%. This is a typical example of the mineralisation that we see at Princeps, with the fluorescence on the right indicating the spodumene. So what's our exploration targets in this? We've got 2 main areas. If you look at this map here, the yellow tenements are the Accelerate Resources tenements. So this trend, you can see all the red marks in there, that's all the mapped pegmatite from all the companies in the area. As you can see, it does traverse through into Mount Shoal East tenement. We've definitely mapped some pegmatites there. We need to do additional work to see if we can find any of the mineralised ones. The Koba trend, besides going straight into Princeps, also sits along the Rayburn syncline. Now, this is quite interesting because The Robin syncline goes on for many kilometres, as GreenTech has announced, but it also now corresponds to the new discovery from Artemis Resources Mount Wray. That continues straight into our tenement. We have multiple kilometres of strike now on an area we actually haven't explored before. So we're looking forward to getting out there as soon as possible. Manganese, I'm running out of time, so I'll be quick. The manganese, we've got we're only 70 kilometres from Woody. We're 240 k's from port, 30 kilometres from sealed roads, but most importantly, we've got 358 square kilometres of highly prospective ground, with approximately 33 kilometres of strike of these wonderful manganese corridors. We've had the project for about 2 years, and we've done what we said we'd do. We'd go out and we'll drill it, and we put resources on it. So we've got maiden resource that came out in December of 1.2 million tonnes at 19.1% with a lower cut-off of 15. With that, what's got us excited, and by the way, that was completed by ERM for the resource. With that, they gave us an exploration target of 5.3 million tonnes to 10.7 million tonnes at 10 to 19%. So we've got a lot of really good ground to follow up on here that we believe we can. And out of interest, when I was looking for resources, go back. Oh, that doesn't matter. Go back. The blue areas is where the resource was. So why invest in us? Well, basically straight off the bat, we've got a maiden drill project about to commence early second quarter. The permitting is well underway for that. We've got walk-up drill targets, and as you saw, we've also got continuity and potential scale size, which has got us most excited. We've got a rapid progression of new targets to drill and to explore. We've got a strong, we've got a potential rapid progression of being able to move from first drill hole through to resource, through to mining license, just the nature of the area. And we've also got a strong pipeline of exploration projects there in the Karratha. And then we've got finally the manganese, where we've got a near-term target of 5.3 to 10.7 million tonnes. So please come see us. I know that probably everyone's out there packing up now, but we'll still be at booth 96. We've got some samples and I'd love to have a chat with you. Thank you very much for your time.
Well done, Luke. Thank you very much. All right, now there's lots of first-time presenters representing their companies here at Explore in 2024. And I think one of the big things is when they are tapped on the shoulder by their company, it speaks volumes about the value that they add to their team and also the information that they have to share with us as a collective investor group with a potential interest in what they have to share with us. So this next presenter on stage embodies that. Her name is Leah Moore. She is a passionate geologist. She's also the exploration manager for Kin Mining. And I asked her what it is about the project she's involved in with Kin at the moment that excites her the most. And she came up very simply with, we have some great money behind us at the moment. And as an exploration geologist, it means I can go out and I can find things that really add value for our shareholders. So let's see what Leah has to add value to our portfolio in the future. Please make her very welcome.
Thank you. So, as said, we have $80 million in cash and share equivalents right now. Got over 930,000 ounces of gold. We have an exciting VHMS discovery, and we're in the middle with extensive corporate activity that continues. The latest one being the Silver Lake Red 5 merger proposal, which is pretty good. So I won't bore you too much with the numbers because there's been a lot of that over the last few days, but we're in a pretty good standing right now. Kin is going to tightly hold the cash that we have, and we're going to take a careful and measured approach to the exploration and value-adding activities. So the Genesis shares, which we acquired with the recent sale of the 610,000 ounces, they're not escrowed, which is important to note for everyone. But we've also doubled our share price in the last 6-7 months, which is key. Our major shareholder, Delphi, is supportive of the Kin team and what we're trying to achieve with our vision. So why Kin? Why invest? Everyone asks their own companies, but we've had quite a journey over the last 10 years. Some people may know, some people may not, a bit of ups and downs. But these are what we believe are the key positive drivers for investments. We have people with a recent transformative track record of deals. We're uniquely positioned right now in that we're well funded, which is, it's a bit of a hard time at the minute. We've got a lot of equity behind us and we can just get on and do what it is that we want to do. We have a great set of projects and with which to do it on, and this new exciting VHMS discovery, which I'll touch on a bit later. Great region. We're going to build value in this company through a variety of opportunities. As I keep saying, we're well funded to add that value to quality projects which we believe are underfunded. And we're always going to continue for people to join our team. So I've mentioned we have a qualified team. Here they are. So we have an active board and management, and I don't think people realize that they're actually in constant communication, sometimes daily, with great working relationships between everyone and an enthusiasm to just drive everything forward. So our team is strengthened through technical consultants from Model Earth, Outcrop Exploration Services, Bruce Hooper, who is ex-Sandfire DeGrussa Discovery, and Polaris. We really do have an excellent springboard with which to launch forward. So we are in the Leonora region. We're proximal to 3 very hungry mills. We're 50 kilometres as the crow flies to Jaguar, and it's a tier 1 district. I'd like to really emphasise that the recent Genesis sales, we only sold 12% of our tenement package, which is about 90 square kilometres. We still have 667 square kilometres remaining and 932,000 ounces. I don't think people really realise that. So we've still got a lot going for us. The Mineary Domain has had for decades a lot of work, and the geologists, the seasoned geologists in the room would know about this. There's a lot of data that has been collected and some bits of mining as well, but it hasn't been holistically put together. We sit in the Kalgoorlie-Canalpi subterrane, and it's historically been thought to be another classic orogenic compressive environment, but recent technical studies show that this might and probably isn't actually the case, and the new regional interpretation is needed, and we'll explain some of the complexities that we have discovered with the mineralization and the new VHMS. So the next 6 months for us, diamond drilling for a small program is currently underway. The results will be released as the program progresses, but we will be doing downhole EM as soon as ready. The drill plan at East Cardinia and the red boxes there show the gold results as well, with the optimized gold pits in yellow. The Albus VHMS discovery is really close to all of the gold action, which is good from a number of aspects, one of which we can continue to explore for both commodities at a pretty low cost. The majority of drilling at Cardinia is shallow, so depths of mineralized structures have not been effectively tested. You can see with the long section there looking west at Helens. So we're going to test it down underneath there. We were lucky with Albus, as it's basically a drill-ready target. So we're going to reassess that data and continue the exploration along other areas of the identified VHMS favourable horizons in pink. And it's very much going to be a reiterative process for the team. So the ongoing exploration for gold is that the large tenement package that we still have, there's significant gold intercepts in there that warrant follow-up. We're now going to take a relook at these using our base metal VHMS understanding and the reinterpretation that we've been carrying out. And if there's no immediate home for our gold, then we will just continue to build the confidence and extend on our resources until the time is right. But there's multiple early stage targets and large gold anomaly trends. Albus. The history of this discovery is that it was part of a larger VHMS exercise a bit to the east. We had a bit of luck and a bit of an open mind and to explore some new ideas. We got a pretty good intercept, 5.7 at 5.3% zinc, 0.3 copper. The significance is that we have confirmed VHMS mineralization along a favourable horizon in the Mineary Domain in an area where there hasn't been any discovered before. It's been all exploration for gold. This mineralization is earlier than our gold, so we now have 2 separate mineralizing events, which in turn opens up a lot of windows for us. So there's nothing like shifting the boundaries of the box a bit so that you can see some more. It was originally an IP target for gold, and we didn't assay for anything other than gold, nothing like lessons learned. The PXRF spot sample that we did after that came back at 2000 ppm, so when we were carrying on with our exercise, it didn't get flagged. So it just shows that when you have some blinkers on for one thing, you can actually miss a lot for all the other geos out there. It's been a massive learning exercise, and we needed the technical expertise of Dr. Carl Brauhart to assist us with the process and the understanding, the nature and the scale of everything. Bruce Hooper has been excellent to help advise appropriate steps forward based on his wealth of experience at Ducler. Here you can see the massive sulfide zone at 270 metres down hole. Some lovely textures there, and the spot results for the PXRF came back at nearly 22% zinc. So somewhere in the Mineary domain is hiding a VHMS deposit, a large one, I'm sure of it. But along with some more gold as well. We have more targets than we can currently shake a stick at, not to sound crass. So it's just a matter of carefully going through the data and prioritising before we start drilling the other horizons, of which there are now 5 across a 40-kilometre strike. So we are going to continue to build a quality team. We're currently looking for a CEO, if anyone knows, to join in on the exciting journey. We have several strings to our bow. We have base metals discovery, we've got gold, we've got district consolidation. We are very well funded to execute these goals and put into place the strategy that we have. Thank you.
Thanks very much, Leah. Marc Ducler is next up on stage to talk about the best undeveloped gold project in Kalgoorlie, held by a junior. And he claimed to me at lunchtime that he has the argument to back it up. So let's hear what he has to say. Would you please make him welcome, everyone?
Thanks very much, Chrissy. Look, 10 minutes isn't actually a lot of time to talk, so I'm going to really try to smash through this very, very quickly. In short, we are a gold-focused exploration and development company. We are focused on 2 projects, both in the West Australian goldfields, that is Mandilla and Fayetteville. We are active explorers. I mean, we've been drilling over 40,000 metres a year for the last 3 years, and that continual drilling has actually allowed us to grow from 116,000 ounces to 1.4 million ounces. And the last 500,000 ounces of that growth has actually come in at an exploration cost of $17 an ounce. So I'd argue we're pretty cost effective at the way that we grow. So as a broad overview, this map just shows our 2 projects, Mandilla 70 k's from Cal, 20 from Kambalda, and Fayetteville only 14 kilometres from Kalgoorlie. It's a fantastic location. There is a history of turning gold discoveries into profitable mines. But at the same time, there's 130 years worth of exploration that's occurred in that area. And as a result, large-scale, undeveloped, open-pit opportunities are becoming really, really difficult to find in this area. And the scoping study that we put out last year is pretty much showing that Astral is in possession of such a large-scale open-pit opportunity. And that is going to be very rare and is certainly going to prove to be very valuable over time. Now, we are currently drilling at Fayetteville. That's our high-grade. There's a high-grade target there called Camperman. We're very confident that we're going to continue to yield high-grade results from that program that is currently underway. Now, I'm going to move straight into the scoping study. There's normally a few boilerplate slides that I would show, but just to get through as quickly as I can. I've unashamedly stolen the format from Capricorn's pre-feasibility study they put out in April last year on Mount Gibson. Now, the reason I've done that is effectively Capricorn is obviously a market darling, and they have proven over time their ability to make a tremendous amount of money on what is effectively very, very low-grade gold projects. The market at the moment is valuing Capricorn at over $400 an ounce from an EV per resource ounce perspective. Astral Resources is running at $37 an ounce, but the grade of Capricorn's ounces in their resource table, 0.8 grams per tonne. The grade of Astral's resources, 1.1 grams per tonne, so 30% higher. Now, obviously the clever people in the room will say, well, all ounces aren't created equal, and I 100% agree with you. So I'm just going to try to screen Mandilla's ounces versus the Capricorn Mount Gibson pre-fees, and that's why I stole their slide format. I'm only going to focus on a couple of the key metrics. So the first box, which you can see on the left, Mandilla will produce 100,000 ounces per annum for 7.5 years at a grade of 1.3 grams per tonne. The Mount Gibson study, and it's on page 13 of that announcement when you go back to April 2023, 150,000 ounces per annum, 7.5 years at 1 gram per tonne. Moving on to the financials box, the Mandilla payback, 9 months. The Mount Gibson payback, 23 months. Their net present value, they calculated at a 5% discount rate. Obviously, we aren't in production, we use an 8% discount rate. But if I rejig our financial model at a 5% discount rate, our NPV is 533 million. Theirs is just over $800 million. Now, the last box, which all the way to the right, is basically saying that both projects are large conventional open pits with relatively low strip ratios. Mandilla 5.8, Mount Gibson 4.2. But the difference is in the gold recovery and the recovered grade. So the recovered grade for the Mandilla project is 1 gram per tonne. Mount Gibson is 0.86. Now, when the gold price hits around $3,100, it actually makes the maths really simple. There's 31.1035 grams in an ounce. So every gram of gold is worth $100 in the current market. So a 1 gram ore body generates $100 worth of revenue. A 0.86 gram ore body generates $86 worth of revenue. $14 advantage for every single tonne. That is more than going to offset that slight increase in strip ratio between Mandilla and Mount Gibson. So just on the next slide. This is conventional load and haul contractor mining model, no different to the way Capricorn conducts their business. Mandilla has 3 open pits and over 93% of the ore is coming from one single large open pit, which is Thea. By comparison, Mount Gibson, 7 open pits and 3 of the pits contribute 90% of the ore, so it is relatively more complex. Then you move on to metallurgy and processing. We get our 95.7% recovery at 150 micron grind size. Mount Gibson is forecast to produce a 92.6% recovery of 125 micron grind size. That is a significant cost advantage that the Mandilla project has over Mount Gibson. Then you go look at the reagent consumptions. Cyanide consumption is the biggest single cost you have from a reagent perspective when you're running a gold process plant. 0.3 kilograms per tonne for Mandilla, 0.8 kilograms per tonne for Mount Gibson. When we did our study, because it was in the peak of the inflation environment, cyanide was being costed at $5,000 a tonne. So just that difference from 0.3 to 0.8 is $2.50 a tonne in processing cost advantage towards Mandilla. Both flow sheets are 3-stage crush, single-stage ball mill, very, very conventional gold flow sheets. And as a result, Mandilla presents as a compelling economic study which screens exceptionally well when you compare it to Capricorn's Mount Gibson project. Now, I will give it, the Capricorn project is slightly bigger. It's 58% bigger, but it's not 2 times bigger. It's certainly not 10 times bigger. It is 58% bigger, and yet the value differential is well over tenfold. So now I'll just move quickly onto a long projection of Thea. This is what a 1 million ounce deposit looks like in a single open pit. There's 2 points I'd like to make on this slide. Our drilling efficiency is continuing to improve. So in 2022, we were at 97 gram meters. That was our average gram meters for every diamond drill hole we put into the project. First half of 2023, it was jumped up to 108 gram meters. And then the last project that we finished, which we just reported in January, 137 gram meters. We are continuing to improve as we drill out this project. Second point I'd like to make, when you look at Mandilla and specifically this Thea open pit and you go 100 kilometers in every single direction, there are 2 deposits that are bigger. You've got the Super Pit at Kalgoorlie, and then you've got the Red Hill deposit, also owned by Northern Star, which is out at Kanowna Belle. So the ounces that we have here are very, very difficult to replicate, and as a result, it will make it very valuable over time. Just 2 slides on Fayetteville. Just checking my timer. Again, Fayetteville is in a fantastic location. It's only 50 kilometres from Mandilla. We have the 92 million ounce Super Pit, 14 Ks to the north. We have South Kalgoorlie operations, also from Northern Star, only 10 Ks south, and then a further 35 Ks south, you have the 20 million ounce St Ives gold camp. To truck from Fayetteville to Mandilla at a $3,100 gold price is going to use 0.1 grams per tonne of revenue, so it's infinitely doable. We only started drilling here in January last year, so it is a relatively new area of focus for us. And Camperman, which is one of the targets, has certainly become a very high grade and high priority target. So just looking at Camperman, we're drilling here at the moment. We are very confident we will continue to yield similar high grade results as we've already gotten. We did 13 holes there in 2023, so not a lot of drilling because our focus has been at Mandilla. 7 of those holes returned pretty significant results. 4 meters at 95, 21 at 4, 35 at 2, 10 at 5, and 5 at 6. We then drilled another 3 diamond holes, targeting the stratigraphy. We really wanted to get a better understanding. Got another 3.7 meters at 12.2, 1.3 meters at 9.2. We are building a high-grade opportunity here at Camperman. And just remember, any high grade that we mine in that Fayetteville target area will truck really well to Mandilla and add a tremendous amount of free cash flow to that project. So in closing, the scoping study that we did demonstrates that Mandilla is an exceptionally profitable open pit development opportunity. When I've spoken previously, I've detailed just how much effort went into that scoping study, arguably much better than scoping and approaching DFS in a lot of the disciplines that really matter. This is a conventional gold deposit from mining all the way to processing. It screens really, really well when you compare it to a project that sits inside Capricorn, which is valued at 10 times the value of Mandilla. The study used conservative revenue estimates, $2,750 for gold. If you upgrade it to today's gold price, the internal rate of return on this project is 98%. The net present value at 8% discount rate is $623 million, and the free cash flow is over $1 billion. We have 4 years worth of proven resource growth, and we are now demonstrating the ability to really focus on a high-grade target at Fayetteville and generate similar resource growth as moving forward. We are active explorers, and we will continue to advance our projects towards development. And lastly, there are no peers in our area that have the same level of development opportunity as we do at Mandilla. Single-stage open pits of this scale in a region as mature as ours is becoming increasingly difficult. Go away. Thank you.
Get up. You do that on purpose. All right. Now, we know when it comes to targets that size matters when it comes to the world of resources. So at the moment, there are some very, very excited exploration geologists. And I looked this word up because I thought I was going to say yodeling. And I thought, hold on a second. Do the Swedes yodel? They don't yodel. The Swedes do something called kulning. So they'll be kulning from the tops of their mountains at the moment in Sweden. The Alicanto's team have got some great drilling results, and the man who's going to tell us all about it is their MD, Rob Sennitt. Would you make him very welcome, please?
Thank you, Chrissy, and thank you, Vertical Events. It looks like you've got a major success in terms of the conference on your hands. It's really great to catch up with all the people here and particularly to tell the story. There's nothing I enjoy more than getting into the story that we've got at Alicanto. I mean, for those that don't know, Alicanto's focused on 2 projects, the Falun Copper Gold Project, which produced over 28 million tonnes of copper at 4%, and the Sala Silver Zinc Project, which produced over 200 million ounces at the unbelievable grade of average grade of 1,244 grams a tonne. So 2 absolutely phenomenal assets, and in our view, their history is looking as bright as their history has done as well. It's interesting you come to these conferences and people are always coming up to you and asking, you know, what differentiates your project from everybody else's. And there are some fantastic projects out there and some great people, you know, and we're pretty lucky in that, you know, that there is that wonderful choice. But from my perspective, it's about leverage. And you look at something like Alicanto has got here. I mean, we're now capped at less than $20 million. If we get anything that looks like 4% copper or 1,200 grams per tonne silver, I mean, this thing is worth an absolute fortune. And in our mind, there's every chance that we can do that. You know, it's all about the people, it's all about the assets, it's all about the jurisdiction. And you know, there's no point being in a jurisdiction which doesn't allow you to do a great deal. And then Sweden is a really interesting one. You know, when I got involved in it, I didn't know a lot about Sweden. Now, Sweden is clearly a tier 1 mining jurisdiction based on the Fraser Institute. It's the biggest mining economy in Europe. You know, it's a place that when I first started looking at it, you know, surely all that Nordic region's all a bit green, it's all a bit hard, isn't it? You know, what's sort of changing there a lot is that the Swedes are very pragmatic people. I mean, you saw that during COVID. You know, they didn't lock anything down. Everybody could come in and out. They think in quite a different way, and I'm very impressed. It's just very pragmatic, their approach. I mean, they're one of the few countries that I've seen that have actually pulled back their energy targets. No longer 100% renewables by 2040. It's 100% fossil fuel free by 2040. Uranium, the uranium mix in Europe is getting bigger. In Sweden, it's 30%. Now, Sweden's had this ban on uranium mining for 40 years, but the talk at the moment is all about uranium mining. The world is changing up there. It's, in terms of when you start to look at what's happening with Russia, etc. The whole European dynamic is changing, and it's a very exciting macro. We've got a great team. The team here in Australia has made a lot of money for a lot of people. The guys we have in Sweden are also fantastic. Eric, our chief geologist, has been the chief geologist of Vallerine and has 6 or 7 discoveries to his credit in terms of where we are. And I keep talking about him as the secret sauce in terms of what we're trying to do, and he absolutely is. Very quickly, though, the assets, as I said, Falun, operated. Both these assets are significant. Both have operated for over 100 years. Falun, in its case, over 1,000 years. When it closed, it had produced 28 million tonnes at 4% copper, 4 grams per tonne gold, 5% zinc, just an extraordinary mine. And we now control over 300 square kilometres there. And what our data is telling us is that we've got a mineralised corridor that stretches over 10 kilometres on those tenements. Csar, in the same vein, was the largest, highest grade silver mine in Europe for hundreds of years. 200 million ounces at an average grade of 1244 grams a tonne. I mean, those grades sort of make your eyes water a little bit when you look at what's around there today. We've got now a 10 million tonne resource up there, but more importantly, our most recent drilling is that we've really started to hit some more high-grade zinc and high-grade silver that is potentially very, very exciting. Sweden, and I touched on it before, it's an interesting story. When I first started having a look at it, what's tough about Sweden is north. That's where you have the Sami people, that's where you have the reindeer herding, that's where it gets difficult. If you want to start something new in Sweden and you head up north there, it is a difficult thing, as it is anywhere in the world when you have those cultural sensitivities. We're very lucky, we're down in this Bergslagen region. You've got the Garpenberg mine there, which Boliden mines, big mine. You've got Zinkgruvan, which Lundin mines. You're in a very big mining community down here, and given you're only an hour out of Stockholm, the infrastructure is fantastic. I sort of throw this up as well. It's again, you've sort of seen a lot of the majors almost avoiding Europe in many ways. They've headed to Africa, they've headed to Latin America, but the world is starting to change a bit. You start thinking about the likes of Europe, and they use 25% of the world's commodities and produce 3%. They've just introduced a Critical Mineral Act, which sort of says you have to start focusing on producing commodities within Europe. So interestingly for me, 6 kilometres away from our Sala project, BHP has just turned up. Which again, I think the message that sends to people, not one that's been missed on me, by the way, is that yes, we're in a great place as far as the geology goes, but also BHP thinks they can do business in Sweden. In my mind, never a doubt, but it's a real indication to people that when you've got the likes of BHP turning up, things are starting to move in Europe. This is Falun. What Eric would tell you is that whole caldera is highly prospective. We've got all of these ore horizons that Eric's mapped, these limestone horizons that host this zinc, lead, silver mineralizations. But what we're looking for there is these tightly packed polymetallic structures, if you like, and when you look at something like Falun, you look how small that is. There's your 28 million tonnes at 4% copper. We lack nothing for targets in here. We've done a lot of EM there now. We've done a lot of gravity surveying, and these are all of the targets that we're starting to identify. And so, as far as keeping a drill busy up there, absolutely no problem. We put our first drill hole here in the Wittgruven, very near an old zinc mine and an old copper mine. First drill hole we put down there, we hit 43 metres of massive sulphide, some great mineralisation, and really have shown that we've got a 3.5 kilometre strike here between the old Falun mine and Wittgruven, never a drill hole drilled in it. Extraordinary when you think about it. The old timers, they just sort of followed the old mine down, but never really did any exploration. And so here we are applying a few, modern techniques, and the targets that we're turning up is just phenomenal, which is unbelievably great for us, obviously. And then not just in that particular trend, but as we start to sort of take them, do our discoveries around or do our work around here, again, just more targets continuing to pop up. So we're back now drilling after those first 2 drill holes at Wittgruven and doing all of our EM analysis, etc. We're back drilling there again. We put a hole just to the west of Fulun, and we've hit the limestone down there, and it looks as though we potentially have another upflow zone there. We've done again, it just seems just a no-brainer that that the Fulun deposit sort of continues at depth, and we've put our first hole down there, and we've hit a conductor down there, and it seems very likely that ore body sort of continues down at depth. No real surprises when you think of Garpenberg and you think of Zinkgruvan. These mines now are down at over 1.5 kilometres. This mine stopped at 500 metres. You know, when you start to look at actually, I'll just quickly go here. When you start to look at some of our modelling here, and you look at some of these grades down beneath Fulun here, you know, here you got 7 metres at 7% copper. You've got 15 metres at 2% copper. You've got 11 metres at 61 grams per tonne gold. When I tell you that there's no lack of targets there, you know, that is absolutely the case. But what is actually sort of getting more interesting as I flip back, and Chris, you probably get really annoyed that I'm going backwards rather than forwards, but you know, we've got this model, like this is the Fulun model, right? And what Eric has been able to work out for us is that we can sort of track where we are in terms of the alteration, if you like. So this proximal alteration that we're seeing here starts to get close to some of this copper stringer zone, which we know sits in the footwall of Fulun. And then of course the big prize here as we get into that, as I say, that tightly packed, elevated copper gold sort of center, if you like. And so the couple of, as I put out recently, a couple of drill holes that we've done in this proximal alteration here, we've had 2 holes into that now. We're just doing our 3rd hole and our 4th hole to follow. As I said, you know, all credit to Eric, his model is proving bang on. And, you know, I'm living a bit of an emotional roller coaster from day to day as we sort of get closer to it. So I absolutely have my fingers crossed that it goes, and it's quite daunting as Christine comes to it. It's almost harder, isn't it? I haven't got time to talk about Sala, as I mentioned, but as we go up here to the north, lots of zinc and silver, really exciting for us there. And a lot of work for us to do there. Thank you, Chrissy. And thank you, everybody. If you get a chance to come out to the booth, it's a great story. I'd love to tell you. Thank you.
Well done. Well done. All right. We heard a lot about elephants today, close to some very, very big, world-class deposits in WA's goldfields. Is not an elephant per se, but the Elephant Project, which is big. It's 194 square kilometres of exploration leases. There's some compelling gold targets in there, so I'm told, and this fellow here is the MD of Tempest Minerals, which has just inked a deal to bring the Elephant Project into their herd. Would you please welcome Don Smith to tell us more, everyone?
Thanks a lot. And thanks everyone for sticking around. I know there's quite a big crowd here. It's been a very, very big conference. I think one of the advantages of coming later in the conference and talking is that you can have the advantage of telling everyone that you're leaving the best to last. And certainly the talks over the last half an hour or so have been pretty unbelievable. So hopefully I can live up to that one now. Moving forward, we'll go to our obligatory disclaimer that I'm sure everyone will read carefully later. And we'll go into some key points. So the thing is about Tempest is that we're a de-risked multi-commodity company. So I heard someone earlier mention about not focusing on one commodity too much, and I learnt that one early in my career is that you always got to have your eyes open for multiple things, and we'll talk more about that later. We're certainly attractively priced at the moment, and compared to the potential that we have in the company, I think that we're extremely underpriced actually, but I probably get in trouble for saying that. And we've got a whole stack of news flow which we're going to have coming forward in the next few months, so I hope everyone pays attention for that one. A bit about the company for anyone that doesn't know. I know there's a few people here that are certainly aware of Tempest. There's a quick snapshot for you. We're, as I said, very modestly valued. Our projects are focused here in Western Australia, and we have some investments around the world as well. We have some funding. Well, it says we have 1.5 in cash there. We also have a sizable investment which we're planning on investing to move forward in our exploration. So we're well funded to do the work that we need, contrary to some of the commentary online. We have an amazing team. We've got, particularly at the chair there, we've got Brian Moller, who many of you may know for Sol Gold fame and many other companies on the ASX. We've also got Andrew Haythorpe, myself, and Owen Birchall. We're all experienced guys. We've all built mines. We've all found things, and we're just looking forward to doing it again. A lot of companies talk about sustainability as kind of a footnote, and a few people have heard me talk about this. This is a starting point. So smart business, especially in the modern world, is you do things well, sustainability-wise, and your business is successful. It shouldn't be something you think about later. So if anyone wants to talk to me about that, we can certainly later. Innovation. So as the previous speaker spoke about, there's always people looking for what makes us different. That's one of the things, is we're using technology in ways that quite frankly, no one else is. And for a small company of our size, we're certainly punching well above our weight. That picture there is an example. That's what's called a box scan. It's a unit out of the UK, and we put all our samples, everything goes through there, and we get objective data, which then we can model in real time. There's no people sitting there typing in Excel. It's about automation. We live in the most expensive jurisdiction for wages in the world. We shouldn't be paying anyone to do things manually if we can avoid it. So that's the approach that we're taking, and it's having some success. At our projects, you can see that, as I said, they're all focused in Western Australia. We've got a bit of a spread, and a spread of commodities as well. Our highlight project is the Yalgoo project. Many of you will have heard me talk about this before. The story here is, if you look at the top of the picture to the bottom, it's about 100 kilometres as the crow flies. And you can see there's at least half a dozen world-class mines there. And previous speaker, 2 speakers ago, we talked at length about that, and the Mount Gibson project at the bottom there. So this is a mature jurisdiction. It's been explored for a lot of time, but there's still a lot of opportunities coming up. And that's where we come in. We've identified that much of the interpretation geologically is quite simply, let's say it has some issues. And you can see the bright green color. They're just some of the opportunities that we've identified over time. And we prove that. So I'll talk more in a moment about that, but where it says Orion, I want you to think about that one just in a moment. I'll go back for a second. Other thing about the Yalgoo region is it's only a few hundred kilometres north of here. The infrastructure is massive. There's power, water, rail, 2 highways, telecoms. It's very, very easy to do work. So that's also a big competitive advantage for us when we're doing things. So earlier I mentioned the Orion. So 2 years ago, almost to the day, 2 years ago, I stood up here and said that we'd identified this new belt in Yalgoo. So it's a long strike from Golden Grove and a number of other quite famous operations. And we found that the same rocks continue where there'd never been a lease before. Certainly no exploration and no drilling. And so 2 years ago, I said, we're going to drill the first hole into that. And we did. And at that time, you can see the picture on the top right there. At that time, we drilled a 1,000-metre hole. That was our starting point for doing that. So we're out here to do proper science and find things. And lo and behold, that first drill hole had 3 ore bodies in it. Unfortunately, none of them were economic grade in the first hole, but it was the first hole. And we've got 50 kilometres of the same rocks that we haven't explored yet. And we're just doing that bit by bit. So also things that we've been doing, you see the top left there, we flew a region-wide EM survey last wide. So that's a pretty serious one. And that came up with a whole heap of targets. Also, while we've been doing our exploration out there, we've been picking away at different targets around. And one of those targets also correlates with, let's just say, a pretty serious anomaly in that EM survey that you can see in the top left. That's what we're going to talk about next. If it changes over. There we go. Okay. So that's called the remorse target. And this came about, so I just said to the geos, I'll be transparent, I said to the geos, when you've got nothing to do, go out there and collect soil samples in that area, because no one's explored there either. And we didn't think much of it. There's nothing particularly outstanding at the surface to tell you there's something there. But when we looked at the data sometime later, we came up with this. So if you look at the red and the blue area there, the red represents copper and the blue represents zinc. And that's pretty exciting because it's very rare, and I'll be honest, as a geologist in my career, I've very rarely seen such a coherent anomaly in the soils. It's very strange. And then when we flew that geophysical survey, it also pointed right to the dead center of that. And so that's about as good as it gets in exploration for a target that you want to drill. So we've been waiting for some approvals, which seem to be coming through now, and we'll be mobilizing very soon to go and drill that. So when we drilled our first hole into this project 2 years ago, let's just say there was some excitement in the market about, and we may have gone for a bit of a run. That wasn't even based on looking for mineralization. That was a science hole. This one, we think there's something there. So I think everyone should be certainly looking at our story very closely for the potential. Just south of that, only a kilometre or so south of that, we've got our neighbours, Warrior Resources. They're drilling, and I believe they've got a resource there now. And directly along strike, we've got very strong gold anomalism. So either as part of the remorse drilling or sometime after that, we'll be drilling here as well. So we've got a whole stack of things planned for 2024. And we also have some other projects. I wasn't going to focus on this one, but the person who put this project has kindly come down to watch me today, so I will mention it in passing as well. The Range project in Mount Magnet. So we're due south of Ramelius Resources, and you can see there's one of the historic pits, a few thousand tonnes were mined there, and it's just a matter of geometry. There was some exploration done along strike from that pit, and they didn't find anything. You go off a little bit, we looked at the data closely, and bang, we found the same kind of mineralization sticking out at the surface. So there's a whole bunch of tourmaline breccia there and rock chips of 1 gram per tonne. So we're going to be drilling that sometime in the near future too. Somebody mentioned an elephant earlier. I'll try not to trumpet on too long today, but this is a lookalike for Tropicana in the middle of the Albany-Fraser region. Happy to talk to everyone about it if you come and have a chat at our booth. Similarly, we've got ground along strike from Rumble Resources and their giant lead zinc copper discovery, which early stages we're getting into as well. Lots of news flow coming up, multiple drilling programs. Stay tuned. And make sure you visit our website where we've got our investor hub, and you can see every announcement we've done and watch videos of me talking about it in more detail.
Good on you, buddy. No, I don't want
Thanks a
that.
lot.
I want your hand. Well done. Give that to the next one.
All right, cheers.
Well done. Okay, we've got 3 investment opportunities left for you to ingest. Koba and Bulletin are chafing at the bit to share their stories with you. And Marc Csar from Bulletin is very, very cocky about the quality of his spodumene, so that's going to be an interesting talk. Future Metals, though, is up next. Patrick, come and join us, Patrick Walta. So they've identified multiple magmatic sulfide drill targets, very prospective. So we're travelling up to WA's East Kimberley region, and you've managed to get him here with your tie intact, whereas many other people haven't today, so we're very impressed. Would you make him welcome, everyone?
Thanks, everybody. It's a pleasure to talk to you today about the Panton PGM project in the Kimberley region of Western Australia. Many of you would know about the Panton project. It has been around for a couple of decades. Many of you wouldn't be aware of the developments that have been made with the Panton project and the evolution of the project over the last couple of years. So very much looking forward to taking you through this and also being part of the team that brings Panton into production over the next few years. This slide really sums up Panton and the advantage that it has. Panton represents an incredibly scarce, very high-grade PGM asset in the Western world. You simply do not find grades this big in the Western world. You can see us on the far left side. That grade, 7 gram per tonne palladium equivalent in the reef, and our overall deposit that we're targeting, 3.3 gram palladium equivalent in the reef and the high-grade dunite, is massive, and it affords us a lot of flexibility and the ability to get a big operation up and running in a tier 1 jurisdiction. So this is a really key graph for us. You can see versus other developers and competitors there, it is a standout, and that's the opportunity that's in front of us. Panton also represents what is effectively a sunk capital play. So this asset is different to many of the other presenters that are here today who are doing some great exploration. But the reality is, from discovery through to first production of any project can be 10 to 15 years. It's as simple as that in terms of drilling it out, developing it, getting the funding and timing the cycle. Panton is very different. It's been through that process and it is sitting there with a very short time frame for being production ready. Now that affords us the ability to time our entry into the market. At the moment, PGM prices are low, but that's fine. We do not want to be a producer right now. In fact, we're quite happy to see production coming out of the market as it is right now. I'll take you through that in a little bit, but that enables us to be strategically ready to be into production as prices start to rise again. When I talk about sunk capital, I'm talking about $50 million worth of investment in this asset over the last 20 years, 45,000 metres of drilling. It's already got a 500-metre exploration decline in place. It's already got mining leases in place, bulk metallurgical test work. It is a very well-developed opportunity, and that we can leverage all of that sunk capital to get a big operation up and running in a quick time space, take advantage of the next price cycle. The metallurgy of the project has evolved and changed. It is a conventional crush grind flow sheet. We are doing the simplest thing possible here, producing a nice high-grade concentrate, sending it 3 hours trucking up to the Port of Wyndham and selling it all over the world. Simple flow sheet, simple mining, high-grade deposit in place. Strategic asset as well when you think about supply. So 85% of global production of PGMs comes from ultra-high risk jurisdictions. I'm talking about South Africa, Russia and Zimbabwe. Now, if you think for yourself, if you're a smelter or you're an end user, 85% of your production is coming from those countries, you're losing sleep. So the ability for you to source material from a tier 1 jurisdiction like WA is highly attractive. And we have a production profile that makes that attractive as well in terms of being able to do large scale offtake deals and sourcing product from a tier 1 jurisdiction. So a lot of advantages to Panton over existing production and even other Western world developers as well. Quick snapshot of the scoping study that was released. This scoping study really pulls together 2 or 3 years of work that Panton has achieved and really rewrites the value proposition of this project based on the evolution of the flow sheet and the simplicity of the operation there. You'll see some of the valuation scenarios is really quite chunky, a good project as well. 9-year mine life, that's just based on 26% of that high-grade resource. So we know this project is going to extend in its mine life as we continue to drill it out and bring our inferred resources into the indicated category. And you're pulling out 72 million of free cash flow projected. So each year you add on, you bolt that onto the mine life. Obviously you bolt a discounted portion of that onto the NPV as well. The cost base is also really important. As I said, PGM prices right now are low. They're at, palladium in particular is at a 10-year low. If you look at that, if you look at the curve that we have here, the all-in sustaining cost curve, Panton is positioned beautifully, second quartile in the cost curve. So if it was producing now, generating margin despite the low prices. Importantly, you're seeing that at the current price, the current PGM basket price, 40% of producers are underwater. So the top quartile is hemorrhaging cash. Supply is getting stripped out of the market. And a lot of that top quartile is old, deep South African mines that were really propped up by very high prices over the last few years. They shouldn't be in production and they won't be. It's as simple as that. So the curve will change. Supply will get stripped out of the market. It's a story as old as time. The cure for low prices is low prices. And we'll see prices start to rise again. And that's our strategy for Panton is we will be ready for that price rise and we will bring the asset into production during that price rise. The other important thing to note here is the scale of production. So 117,000 ounces of PGMs. And when you roll in a nickel credit and a chromite byproduct as well, you're talking about a tick over 161,000 ounces per annum of palladium equivalent. Now, what does that actually mean? Well, it actually makes you relevant. It actually makes you institutional grade. We're talking about one of the top 5 PGM producers in the Western world. So again, we're not talking about South African production or Russian or Zimbabwean production, but we're talking about production that people can actually invest in. So if you're a big New York hedge fund or something like that, and you're looking for exposure to PGMs, this is an investable asset as it gets into production because it's a big scale and it's in an investable jurisdiction. So really important points from an investor's perspective, that it has that credibility. It has a size that you can invest in and a location that is investable as well. Simple mining, you can see an overview of the mining there as well, and also the mine life. So long haul open stoping is proposed to occur here. The WA labour market has extensive resources and experience in that method there. And you'll see our mine life here as well, and the value of us extending. So we'll keep bringing on those inferred resources into the mine life, bring them into indicated, and that's going to just keep bolting on value into from our value proposition. As we talked about, metallurgy of this project 20 years ago was complex. So originally only being able to get an upgrade of say 3 or 4 grams of ore in the ground to 25 grams. That has changed. The flow sheet has evolved, and the upgrade now is going from 3 to 4 grams to up to 200, 250 grams into concentrate. It means we can just produce a simple con, and as I said, we put it in a truck, we send it 3 hours north, and we sell it from the Port of Wyndham there. So it's completely simplified the flow sheet, dropped the capital costs, and made the project far easier to execute and get up and running. Very quickly now, I'd just like to go through some of the other exploration potential. So late last year, we acquired a company called Osprey, and Osprey's got some really exciting ground around us. That Osprey in its own right was a company that was looking to IPO, and they had that opportunity, and they had the assets that could afford that. These assets inside Osprey alone were exciting, but when you combine them with the location and you combine them with Panton, they get even more value. So particularly Eileen Bore, for example, is about 10 kilometres from Panton itself. So we discover anything at Eileen Bore, we bulk up 5, 10, 20 million tonnes, that's going straight through the plant that will be operating at Panton. So hugely valuable discoveries within an economically transportable region of Panton itself there. Eileen Bore looks to be pretty special though. We're talking about a few drill holes to date, but over 100 metres of selected PGMs, nickel and copper, potential to be something like 2% copper equivalent, 100 metres from surface. So we're pretty excited about putting some holes in that, expanding that story out, and ultimately seeing if that can be another feed source for what will be a Panton processing plant in place. I'll just summarise it now. Thank you everyone for listening in, but what we do have at Panton here is a globally significant PGM development asset. One of the biggest in the Western world, one of the highest grade in the Western world. It is going to be a second cost quartile producer, generating that free cash flow through any part of the cycle. And strategically, we have set the business up so it can time its entry into the market as prices start to rise. Thank you very much.
Well done. Okay. So, Koba is our second last opportunity for you today. Now, they are Perth-based. They're scouring the globe, though. Are you not so? Scouring the globe in search of or evaluating acquiring value-adding assets in the battery mineral sector. They've got lithium in Canada. Yeah.
Oh, we're focusing on uranium in Australia.
Yeah, and I was going to tell them where you were.
Previously.
Yeah, okay. Well, this is Ben Vallerine. It's Vallerine, isn't it?
Vallerine, yep.
Vallerine, and he's the MD for Koba. I'll let you tell the story, sir. Go on, make him welcome, please.
Thank you, Chrissy. Well, actually, just 3 weeks ago, Koba acquired a uranium project in South Australia. So we have moved since recently, Chrissy was aware of, previously lithium in North America. But now we're focused on the Uramba uranium project in South Australia. It's the premier uranium district in Australia. This is a photo I took from my camp where I stayed last week. That's the Honeymoon mine in the distance there. You can just see the lights on. So that's Boss Energy's operation that they've just recommenced recently, and they're getting ready to produce their first barrel of yellow cake. So our timing has been very good for uranium. Obviously uranium's run up to over $100 a pound, the first time since 2007 that uranium's reached that kind of heights. And we've been working on this project since about October, so we're slightly ahead of the curve, and we're able to get that transaction completed in January. And now we're looking forward to moving forward and aggressively exploring this project. So just a little quick summary on Koba. So on completion of this transaction, which is subject to shareholder approval later in March, we'll have 158 million shares on issue and market cap of 26 mil, and that'll, with $6 million in the bank, we're in a position where we can aggressively explore this project. You can see here our share price performed pretty well on the announcement. We're trading at 8 cents and doubled pretty much overnight on the acquisition. So where are we? So we're in South Australia and we've picked up 5,100 square kilometres of ground. So it's an enormous project. It's actually 120 kilometres from the top end to the bottom end. Now that's as far as Yanchep to Mandurah. So it's an enormous project, a lot of prospectivity. In addition, we have over 250 kilometres of paleo channels, which is really, really exciting. That's where the uranium's hosted. And there's a lot of uranium and paleo channels in the district, which is what I'll talk about. So Boss Energy is our nearest neighbour. So they're in production. They have over 70 million pounds of uranium in resources, 620 ppm. The Honeymoon mine itself is just 17 kilometres from our property, and it has a resource of over 36 million pounds. And even closer, their satellite deposit, the Jason deposit, it's a 10 million pound resource at 790 ppm uranium, and that's just sitting 4 kilometres from our Mount John prospect. So it's an established uranium district. We're in a permitting-friendly environment. The South Australian government are very excited to have uranium production there, and they're shipping yellowcake out of the Port of Adelaide. The 3 producing mines in Australia are all located in South Australia. One of the other operations is Heathgate. Heathgate are a private company, so you do not hear a lot about Heathgate, but they have 4 deposits, over 165 million pounds at a grade of over 2,500 ppm. So an outstanding deposit. And in fact, Beverley's been producing for 20 years now, continuous operation for 20 years, and it's produced over 40 million pounds of uranium in that 20 years. So it's a truly world significant uranium deposit. And both Honeymoon and the Beverley operation are all ISR operations. So there's no actual mining, no digging up the ore. You drill holes and you circulate fluid through the ground and recover the uranium that way. A very upscalable kind of mining method. So the first 3 projects that I'm going to talk a little bit about today are the Oban deposit in the centre there, the Uramba North prospect and the Mount John prospect. So this is the Oban deposit. It's the most advanced deposit on our property to date. It has a JORC 2004 compliant resource of 260 ppm and 4.6 million pounds. No work has been done at this project since 2012, so it's still a 2004 compliant resource. But there's an excellent opportunity here to discover additional high-grade zones. Some of the significant hits within this resource include 7.5 metres at 831 ppm, 4.5 metres at 964 ppm. So there's some really high-grade components. We've got a team now working on this deposit, trying to unravel the high-grade and the thicker zones and see if we can piece together a geological model and really get to understand this deposit and locate that thick, high-grade mineralisation. There's significant potential to expand upon this resource as well. The last bit of work that the previous operator did was drilling a series of monitoring wells, and the monitoring wells here are shown in white, and the monitoring wells are supposed to be drilled outside the resource zone, but when they probed these holes, they identified significant mineralisation in these holes. 1.3 metres at 827 ppm in a hole that ended in mineralisation. Supposed to be a water monitoring well and outside the resource zone. So there's a lot of scope to upgrade this resource with a true understanding of how the uranium is behaving. There's also opportunity to expand beyond Oban. Oban's the most advanced deposit, but it sits on a 7-kilometre long trend. And with that trend, there's other significant mineralisation, particularly at the Berber deposit, 1 metre at 860 ppm and 0.5 at 1200 ppm. So there's a lot of smoke in this area. It's a target-rich environment, and we've got 5,100 square kilometres to explore, and there's smoke like this all throughout. So we're going to commence drilling, looking to expand upon this resource, looking to discover additional deposits that aren't known, and we think this 7-kilometre long trend at a barn is a perfect spot to start. There's numerous drill holes along the 7-kilometre trend containing gamma radiation signals of up to 20 times background. Historic drilling in the 70s and 80s has identified some of these zones, and they've never been followed up. 20 times background equates somewhere in the order of 100 ppm, 150 ppm. So it's quite significant mineralisation that has got room to expand. There's also 30-metre intervals of sand in these zones, and the sand's really, really important because that's the host of the uranium. And as long as you get some reducing material in that area, that's where you get your uranium. So this is our secondary project, Mount John. So we're currently working up a drill program for Mount John as well. What I really like about this project is its proximity to Jason and 50 million pounds of uranium as well. So it's an extension of the same geology that hosts both Honeymoon and the Jason deposit, and also the Saffron deposit. So there's over 50 million pounds within about 20 kilometres located within this paleo channel. As you can see here, it's been drilled a little bit. Scale is really tricky on this project. You look at this, you think it's got a bit of drilling on it, but this particular image is 20 kilometres from one side to the other, and some of the drill spacings in the centre of this, wrong button. Some of the drill spacings in here, they're 400-metre spaced drill holes. The Oban deposit, the Honeymoon deposit itself is only 800 metres by 400 metres. So 400-metre spacing is quite significant, and room to tighten this up and make significant discoveries at Mount John as well. So there's numerous prospects to explore. As I said, there's 5,100 square kilometres and 250 kilometres of paleo channels. Another project I really like is the Yarraramba North prospect, drilled by 200-metre spacings, significant intercept of 2 metres at 530 ppm. They followed up with some holes 100 metres apart, intersected another 100 ppm, and it's never been followed up since then. So 200-metre spacing is very, very coarse when you consider how these uranium deposits behave. As I said, the Honeymoon itself is only 800 metres by 400 metres. So there's certainly ample room to be able to discover another Honeymoon within this project. And as an exploration geologist myself, I've spent 10 years working in uranium in the USA on very, very similar style deposits. And I'm going to be aggressively exploring this. We're cashed up $6 million. Permitting process is underway, and we'll be aggressively exploring for exploration as soon as we can get on the ground. Permits have been lodged as we speak. So as I said, this is the drilling at the Oban resource deposit. We're planning to drill about 10,000 metres in our first drill program, which will focus at Oban and also the Mount John deposit. We're also conducting a detailed technical review at the moment to generate future targets. There's so many targets out here, it's unbelievable, and we're developing a pipeline of projects to be drilled later in this year and in the future. So the previous operator out here was Kernamona Energy. They had it from 2005 to 2012. They did about 100,000 metres of drilling, 1,000 holes. But during that time, they were able to achieve a market cap of $120 million during the previous uranium price rise. So we've acquired an excellent team. We've got an experienced uranium geologist, myself with 10 years experience in uranium, and basically we're looking to get out on the ground and be an aggressive explorer.
Good on you, Ben. Well done. All right, we are finishing Explorers. We're finishing the opportunities for you to invest in with lithium. Not just any old lithium spodumene, though. This is very special lithium spodumene that's made Marc Csar very, very excited. And in keeping with their practice of finding projects which are within practical haulage distance of existing infrastructure, this spodumene is located down near Ravensthorpe. Would you please make, on behalf of Bulletin, Marc Csar, welcome today.
Thanks, Chrissy. Just a starting photo, a bit of pegmatite, and for those who've seen us in the booth, that's Sam Cole, who's been bearing with me for the last 3 days. Just a little introduction about Bulletin to start with. Bulletin's listed on the ASX back in 2010. 293 million shares on offer. And we've got a very experienced board. Paul Polly spoke earlier this morning about lithium. He's very excited about the lithium market. And we've also got Keith Muller on the board. Now, Keith, and I'll talk about it going forward, used to be the operations manager at Mount Catlin Mine, which we're just down the road from. We're very well funded with $12 million in cash and receivables. And we've also had the opportunity to reward our shareholders. Back in 2016, we sold a 20% share in the Nicholson gold mine, and we redistributed that money back to shareholders at 8 cents dividend equivalent. And the share price at the time was 5 cents. So where we can, we'll reward our shareholders. I want to talk about the Ravensthorpe Lithium project. That's our flagship project. As Chrissy said, it's just down the road from Mount Cattlin in the Ravensthorpe area, 12 kilometres along strike on the Annabelle Volcanics in the same geological sequence as Mount Cattlin lithium mine. It's 100%, the ground is 100% ours. It's in a fantastic area for mining in the area. Mount Cattlin has a lithium processing plant in the area. We've got high-grade spodumene samples in our ground just in there. We've done some initial test work, metallurgical test work in there using Mount Cattlin's plant as a model, and we're seeing very similar metallurgical recoveries to what Mount Cattlin sees. High-grade lithium concentrate of greater than 6%, benchtop work greater than 75% already, and very importantly, very clean mineral, which produces a high-grade product. And I'll talk about it a bit further on. We've got lots of pegmatites. There's two main lithium trends in our area, and we've basically called the eastern and the western pegmatite trends. The eastern trend's the one that's most interest to us. It's 4 kilometres in length, and very importantly, down the southern end is where we're seeing some high-grade, very coarse spodumene crystals, grades 5, 6, and 7% spodumene. And these spodumene grades are over about 100 pegmatite outcrops. And down the very southern area is the area where we've got most interest, where we're basically seeing spodumene as a dominant mineral. We're calling it the big pegmatite area. It's not one pegmatite in itself, it's a series of stacked pegmatites. Up to 40 pegmatites in the sequence, all very closely aligned, dipping underneath one another. Individual pegmatites are up to 200 metres in length. They pinch and swell up to 10 metres in thickness from what we can see on the mapping, the outcrops. Not exactly brilliant, but we do see quite a bit of outcrop in places, and often just the wall of the pegmatite itself. And our mapping shows that the pegmatites, like Mount Cattlin, dip very gently to the west and to the southwest. We're still open at depth below cover into our tenement. Quite often in this area here, the slope of the ground is just following the slope of the pegmatite. So the gentle slopes of the hills are just the walls of the pegmatite. So we don't actually get to see inside the pegmatite, but we do get to see the feldspars on the edge. And quite commonly in the lithium industry here, we use a mineral called microcline to use potassium rubidium ratios, which gives us an indication of how fertile or how much lithium's dropped out of the system, out of the melt. The lower the ratio, the better it is. And we're finding very low ratios, less than 15 potassium rubidium ratios, which indicates to us that the pegmatites are very fractated and the lithium's dropped out of the system, most likely into spodumene, and that's supported because you see so much spodumene on surface. Just some samples of how coarse the spodumenes are in there. We're seeing crystals up to 30 centimetres in length, but commonly 10 to 15 is not uncommon. And the good thing about most important thing about the coarse grain spodumene samples is in the metallurgy. That's what gives a very high quality product at the end of the day. We carted about 100 kilos of sample out from the area and put it through a conventional dense media separation circuit, very similar to the Mount Cattlin one. And it shows we're seeing very similar results to what Mount Cattlin processing plant is. And it's not unsurprising considering we're in the same geological sequence. So we're seeing, as I said earlier, grades greater than 6% lithium concentrate, very good recoveries, even at benchtop scale, and very clean material. We haven't done any optical sorting or anything further beyond an initial test to see whether it's worth progressing with the program or not. But certainly BHM, who have been our metallurgical consultants, are very highly encouraged in what we're seeing, and they do a lot of work for lithium around various projects around the world. And they're very interested to see what we've had and very excited for our project. There's a second trend as well as the eastern trend, which is spodumene bearing, but the western trend, which we've also got, is more focused on lepidolite. The area's been previously explored with rock chips before, and we've come through very high for lepidolite, very high grades up to 4.5%. It's not as high grade as spodumene, but for lepidolite it's very good. And we've also seen spodumene down the very southern end. There's about a 100-metre long outcrop of spodumene just on the very southern end. That's on the edge of our boundary, and Mount Cattlin has all the ground to the south of us. But our focus is very definitely on the spodumene, considering that the Mount Cattlin mine's just down the road. And we are using Mount Cattlin unashamedly as an exploration model. Mount Cattlin currently has a resource of nearly 8 million tonnes, or about 4 years of mine life left to go. Their spodumene, very similar to us, is in the south, and they have lepidolite to the northeast. I've got an old cross-section here of one of their early cross-sections in here. They've got very flat-lying, gently dipping pegmatites, which is what we're seeing in our mapping. They have numerous stacked pegmatites. They're not one big thick unit. There's multiple units in there, and they have variable thickness. They pinch and swell from 2 to 22 metres. And that's what we think we're going to get when we start drilling. With all our rock chips, which I showed you before, there's been no drilling in that area. And that's what we're planning to do. So where are we at? We're planning to drill. We've got a drill program in place. We were last year, spent a lot of time with EPA. We're looking to see where they wish to assess it. We're in a timber reserve, a coconut timber reserve, so we're having to need a native vegetation clearing permit. EPA spent most of last year looking at us, deciding whether they needed to do further work on us. At the end of last year, they decided not to assess us, and we could just go back into the normal DMERS, native vegetation and PW process. So after last year, at the end of last year, we went back to the start of the DMERS process, and we're well and truly advanced on that. And we're hoping to have our approvals before too long. We've already done all our environmental works. We've done flora, fauna. We've had the heritage surveys done through the area, and there's been no issues. So we're hopeful of everything coming through within a good time. And as soon as we have them, we'll be in there as soon as we can. It'd be interesting to see what we get with our drilling. I'm looking forward to it. While we're waiting for our approvals, we've done a fair bit of work with the drillers getting ready. We've already marked out where we want the drill tracks to go and where we want the pads to go. We're all ready to go. Really, we're just waiting for our permits to come through. I'll just touch on our other projects. At the start, we are a lithium and gold explorer. Our gold project is out at Lake Rebecca. It's 150 kilometres east of Kalgoorlie. We're currently being surrounded by Ramelius, who have been very busy and active in the area. Our ground is now surrounded by Ramelius, and there are 2 large deposits in there, Lake Rebecca, which Peter Rizika spoke about yesterday, and Lake Roe. We've got 600 kilometres of ground, and importantly for us, our Lake Rebecca project is right on the boundary of Ramelius's Rebecca deposit. On the left-hand side of the slide there, just at the very bottom, if I don't get this right, that's the edge of the optimised pit just in here. Originally, our ground went just through in there. In 2019, we sold that 400-metre strip of ground for $5 million in cash and shares to Apollo at the time. And that's part of why our cash balance is so well just now. We retained 700 metres of strike along there, and we're seeing, when we drilled it, we've seen similar grades to what we saw on the ground we released to Apollo at the time, and now Rebecca, and now Ramelius. On a broader scale, we've got 600 metres of ground. There's still another 7 kilometres of gold in the regolith that we still need to test. We've barely touched it. Our focus really has been on the lithium. We're really excited about the lithium side of things. We're focusing all our energy on that. Just south of Lake Rebecca, Chifley Gold Project, also just down the road from Ramelius's Lake Roe. It's on the Claypan fault structure. There's a 1 kilometre across gold and with supporting copper anomalism in there. We've only just done soils in there. We've still got a fair way to go to define a drill target, but it certainly looks interesting. Another area where there's greenstone sitting along a granite. And we do have another couple of other plays in there, and I'll just put one up for interest here. Mount Farmer, it's out near the Dalgaranga ground, near Spartan Resources, just to the south of us there. Rubidium and lithium deposits in the area. There's a few beryl deposits in there on our ground. We're just waiting for that to come and get granted. So we've got a lot of projects coming on, and I see Chrissy standing up. Oh, sorry, thank you. Look, we're really keen about our Ravensthorpe project. By far and away, that's our major focus and our effort, and we're hoping to get our approvals through shortly. And when we do, on ground of those, we'll be getting in and drilling and seeing what we see there. But we've certainly got lots of opportunities on other fronts as well. Thank you very much, and thanks, Christian.
Well done, Marc Csar. I had a full 35 seconds left in the programming today. A little bit of extra space I got, and he took nearly all of it. That's Stephen Wray. How are you going?
Well, thank you, Chrissy. You?
Yeah, not bad. You've been doing a little bit of warming up out the back there.
Yeah, there's a bit.
I like it when you open up Stephen is from Noah's Rule, as you would have read in your program. And when you open up the website for Noah's Rule, it says that predicting rain doesn't count, building arcs does. So that's one of my mother's favourite strategies in life, is prevention is always better than cure. And with that in mind, the title of your talk today is How to Pick Your Debt Dance Partner. Would you please make Stephen very welcome?
Thanks, Chrissy, and thanks to everyone for lasting the distance, and to those of you at home online, thank you as well. So a lot of speakers have talked about the time it takes to find a deposit and bring it into production, that 5, 8, 10-year period. What we think, as you're getting close to production, you want to build something. If you choose to go down the debt path, then that's sort of where the rubber hits the road. We think finding the right debt partner and having the right structure and price protection strategies in place is pretty important. There you go. So choosing the correct debt provider that suits your particular needs and objectives is actually more important now than probably ever. Simply put, to use the analogy, lots of debt providers will have tickets to the dance. But saving the last dance for the ones that know the dance steps and can maintain a rhythm that suits your music is the challenge. Think about timing when you ask your debt partner for a dance is just as important. You need to understand and be fully ready for the challenge ahead. Let's face it, there's no point trying to dance the tango if your partner's doing the waltz. So who are we? Well, first off, we're pretty proud of the fact that this year we're celebrating 20 years in business, which for a smallish business is a great achievement. And for those existing clients of ours, look forward to something later on in the year along these lines. But we grew from hedging advice and execution services to include debt advisory services. We're not just hedging people. Our principals, Dave Rowe and Sean Russo, will be known to many of you, and Sean is in the room today. For myself, I've got a background in project finance, can track back to funding IGO into the Long Nickel project, and I'm based in Perth. So we've done near on $3 billion of debt advisory work over the journey, ranging from about $20 million to about $450 million in transaction size. Typically and unashamedly though, focused on the people who are presenting at this conference, many of you in the room. So we believe that our customers should establish their own set of criteria and objectives and understand the risks and rewards attaching. We are happy to independently guide them through this process, and truth be known, we just like doing good work for good people. Through the journey, we've done a lot of commodity work. Our fees are skewed to success allocating the bulk of the payment at the back end, and a large proportion of this is at the customer's discretion after the work has been done. So we're happy to back ourselves in to do good work. We also don't believe that you can prudently look at debt in isolation without considering the price risk and your alternatives to manage that risk. Given we are considered by others to be experts in the field, we believe that gives us a reasonable advantage. Some of these might be a little bit old, but I just use them to show the broad range of customers and customer size and commodities that we've looked at over the years and helped. We currently have roles in Australia across various commodities and states, with some being new project developments, whilst others are expansion of existing operations. We're happy to say that over a decade ago, companies such as Perseus and Panos sat in this very room as pre-production explorers, formed a relationship with us for their initial debt funding transaction, and a relationship that continues today for them and for many other customers for their metal sales and ongoing financial advisory needs. Others have been taken over or merged, and that allows us to cross-pollinate, and there's some names that you will see there are currently looking at those sorts of things. And our business is absolutely set up to support companies as they transition from explorer to developer to becoming a producer. But enough about us, the subject matter. So broadly, everyone understands the cost pressures that are in place for the industry. Simply put, it's very difficult to develop a greenfields project, notwithstanding there may be available debt capital. Truth be told, apart from a very small handful, traditional banks are now not that interested in funding single asset mining company, mining company developments whose market cap might be, say, $200 or $300 million or less. The nature and the mix of the debt capital that you can get is ever changing. These layered levels of debt certainly provide capital and potentially longer tenor or more relaxed terms, but they also bring increased complexity into credit agreements being required, as well as complexity perhaps in the borrower's ability to structure proper and thoughtful price risk protection strategies, as sometimes these are just simply not allowed. Whilst there has been an abundance of cash being held and invested across the globe, the flow to the resource sector has been, frankly, spotty and very commodity conscious. So you certainly need to understand who might be capable of meeting your needs. General observation for traditional banks, there are less banks prepared to lend to the sector. I think that's a fact of life. Minimum debt sizes are increasing, as well as the preferred borrower size, market cap size, etc. Gold is certainly less popular with some financiers in the ESG context. There is a general appetite to finance green, future-facing green commodity projects, but it needs to be recognised that some of these commodities may not be hedgeable at this point in time. Banks will naturally gravitate to larger scale projects, larger scale sponsors. It's interesting to observe recently with Liontown, and making no comment upon the project itself, but clearly they had some finance in place, and within 2 or 3 months with volatile price movements, those financing agreements are now being renegotiated. So that speaks to the volatility and the risks that a would-be producer faces. You could also say those same risks are apparent for someone, say with a gold project, where they can hedge their price risk. That period between getting funding and building and producing is quite, they're almost financeable, let's call it. That's a term we like to use. But it's a very risk, you have to be very conscious of the risks through that period. So where possible, of course, mandatory hedging to support debt facilities will be required, but actually not all banks execute that, so capability is a real key consideration in bank selection. Certainly banks will assume commodity prices according to their own internal price decks, which they generate themselves based on an in-house and conservative view. Dependent upon the bank, these might only be reviewed once or twice a year, and certainly can be historically anywhere up to 25% below the current forward price curves, even more if prices are particularly volatile and rising in short periods. For non-bank funds, the general observation here is there are more non-bank providers willing to lend to the sector than there has been before. Certainly non-bank providers will be prepared to lend smaller amounts than the banks. They can also often see future expansion possibilities in a better light and may often be prepared to give weight to those future expansion plans. They would generally move quicker than banks, but increasingly are becoming more bank-like in their terms and their covenants and conditions. We certainly obviously see the emergence of agencies like NAIF and EFA, for example, filling the void between traditional debt and the equity piece. Longer term debt at commercial bank rates is the model. Certainly the agencies have been less concerned in lending to non-hedgeable commodities, but the reality is that some recent difficulties are impacting their appetite, their terms and their structure. So we continue to urge caution for the borrower in fully understanding the attaching price risks in any unhedged structure. So this is a very short slide on a whole range of other providers, but the general observation here is that there are more other providers willing to lend to the sector. Off-takers or OEMs keen to lock up supply of product are becoming more active in funding. It wasn't that long ago that if you funded a project from off-take financing, there were question marks about the project's viability. That's not the case these days at all. They can be flexible and certainly a viable alternative source of debt capital. The true cost of any of these sorts of arrangements absolutely lies in the detail. By their nature, off-take finance and metal streaming arrangements, for example, are anti-dilutive to shareholders upfront, but they will be revenue subtractive when the mine comes into production. Intercreditor agreements, again, are a key consideration to allow for any other secured creditors, and it's critical for the borrower to consider the impact on the residual available metals or cash flow that's available if other debt is required. Subordination arrangements can be complex, as the streamer or off-taker will require first security rights to the metal product under the streaming arrangement, for example. They might not be so concerned about your price risk, but certainly while you owe them money, you probably should be. And for us, certainly in the context of single asset companies, we believe you should never speak about getting debt for your project without at least considering the risks of price movements. Too many times we see that everyone pushes back the hedging talk, as we call it, until the very end. It's often too late by then. You're probably locked into your funding arrangement and very much likely to have less negotiation room for volume, pricing, margin, etc. So if you remember only one thing from my presentation today, please remember that the earlier you have the hedging talk, the better off you will be from a structural, debt servicing and cost perspective. To summarise this slide, I think the key consideration for any company is the balance between the amount of hedging completed compared to the impact or dilution of required equity levels. The ultimate cost of hedging over the life of the loan or the life of the hedge must be measured against the value of the early pre-production equity dilution that is avoided. Importantly, any hedging should be structured to enhance the probability of being able to repay your debt under a range of circumstances. Whatever hedging levels are entered into, the key is to determine what you, the producer, wants to achieve from a hedging program. Many lenders will seek to implement what we think is more hedging than is actually required or sensible for the producer. So you need to work out your own drivers and objectives before commencing the financing process. So clearly the flip side to hedging is no hedging, but we would like to think there's an intelligent and nuanced discussion that can be held to determine exactly where you, as the producer, wants to sit on the risk-reward matrix. In essence, the no hedging position kicks the risk to equity down the road. It may never be encountered, which is obviously a great thing, but the downside scenario risks are clearly heightened. We are not so sure that investors buy a share in a gold company, for example, for exposure to gold. There is a physical or the EFT alternatives available to those investors. If you buy a share, you accept all types of risk, mining, management, market, and others. So we're not sure that the no hedging approach in this context is a justifiable defence. In the context of non-hedgeable commodities, we've seen recent examples of price movements, as I mentioned earlier, that can have the potential to derail funding arrangements. It is imperative that the borrower understands the basis of financiers' price assumptions at the very start of the funding process, and just as importantly, periodically through the debt service period. So to summarise most of that, but you need to be clear and clarify your company's commercial and financial objectives. Need to understand the key issues of importance to all stakeholders and determine the expectations and corporate objectives and aspirations of your company. If you don't have a clear idea of what it is that you want to do and what you don't want to do, you run the risk of many lenders and some advisors just taking a cookie cutter approach which may not suit your specific individual needs. Be realistic about your true funding needs up to first production and in the ramp-up phase. The sources and uses of funds are just critical in this. How many times have we seen would-be producers return to the equity market when they are perhaps 10 or 20% away from completion? This can often be the most dilutive raising you'll ever undertake. So work out the debt carrying capacity of the project using the recently observed lender price decks and project ratios and recognising the market risks inherent in the financing. Also the levels of equity required and the impact of using different hedging strategies to protect that price, or at least to mitigate that price risk. The debt capacity analysis should assist you in finalising a financing strategy and you can then approach in a targeted manner those financiers that best suit your desired outcomes. Be completely transparent. If you understand your project, then you will understand where the pressure points, or what we call the points of pain, actually lie. Don't be afraid to disclose them to financiers, because they don't like surprises. But when you disclose them, also disclose your thoughtful risk mitigation strategies for dealing with these issues. And finally, I'll leave you with this thought, which kind of neatly reflects our view within Noah's Rule. I thank you for your time. I understand I'm standing between you and free drinks. So if you want to talk to us at the function, please do so. Also, feel free to contact us at any time to discuss your needs. Thanks very much.
You're not standing between us and anything. You're giving us great advice, and we thank you for it. Do we not, Room? Yes. Yeah. Thank you to all of you who have stayed in the room to the end, and I hope you got a lot of use of that information that we were just given then. And for those of you who've been playing along at home and stayed to the end, congratulations to you too as well. You certainly scored a corker of a final presentation there. 104 presentations, guys. Yeah, that's a lot of great opportunities, isn't it? Really, really good lot of opportunities. Thank you so much for coming along and being part of it. If you'd like to follow what Vertical Events is doing a little bit more and coming along to one of our other conferences, we are in Singapore at the end of March. You're more than welcome to come there. The Ruffles is just next door to where we are. We all go and have a little Singapore sling and think about what we can invest in as far as future-facing commodities go. And we'll be in Sydney in May, and then I think we're off to Gold Coast in June. So you're more than welcome to come with us, and there's many other events as well planned during the year. Best of luck with the information and the intel that you have gained over the last 3 days. And if we don't see you before, we'll see you here same time next year. Thank you, everyone.